Hello, and welcome to Connected with Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Omar Nazif, a project finance partner in the San Diego office, and my co-host today is going to be Michael Gergen, of counsel and a recently retired partner in the project finance and energy regulatory practice in our Washington, D.C. office.
Great to be here. As Omar said, I'm Michael Gergen. I'm of counsel here at Latham. I have worked with a number of Latham clients over the last approximately 11 years who've had a significant involvement with the Loan Programs Office at the Department of Energy with regards to loan guarantees. And these included clients who've been successful in obtaining loan guarantees for utility-scale renewable energy projects.
Thanks, Michael. We are both excited to welcome a special guest to the podcast today, Jigar Shah. Jigar is the recently appointed Executive Director of the Loan Programs Office at the Department of Energy. Prior to his current role, he was co-founder and president at Generate Capital, and prior to that, Jigar founded SunEdison. You may also know Jigar from his longtime role as one of the hosts of the Energy Gang podcast. Jigar, welcome. It's great to have you here today.
Thanks for having me.
We thought we would focus on some of the practical realities that companies considering applying for a loan guarantee from the Loan Programs Office for an innovative energy project should be aware of, and then spend some time talking about LPO's involvement in the offshore wind and electrical vehicle industries.
Sounds good.
For background, under the Innovative Energy Loan Guarantees Program, under Title XVII of the Energy Policy Act of 2005, the Loan Programs Office has the ability to provide in excess of $20 billion of loan guarantees to energy projects that use innovative technology, where commercial lenders cannot or will not provide financing. These projects can be in three areas: renewable energy, efficient energy, advanced nuclear energy, and advanced fossil energy. Jigar, is there anything else you'd add on background on LPO's programs?
No, on the Title XVII side, that's pretty complete. I mean, in general, I'd say that the Title XVII looks and feels a lot more like project finance, whereas the ATVM program, the Advanced Technology Vehicle Manufacturing Program, is more around building the supply chain for electric vehicles and whatnot.
That makes sense. And we'll hit on electric vehicles a little later, and it'll be great to hear more about that. So we wanted to get into some of the practical realities that companies considering getting loan guarantees under Title XVII should think about. Our understanding is most of the DOE loan guarantees issued under Title XVII so far have been in the power sector and have mostly focused on projects with long-term committed offtake agreements, long-term power purchase agreements, or the like. And some of those types of offtake agreements may not be available in some of the new industries that people are focused on, like battery manufacturing or, for instance, energy storage projects that are operating merchant or without a long-term power purchase. Are those industries and projects able to access Title XVII loan guarantees?
Yeah, thanks for the question. I mean, I can only imagine the scar tissue that Michael carries from all the loans he tried to get through the Loan Programs Office over the last 11 years. I'd say that, we've reformed the program quite substantially, not just because it needed reform, but also because we learned a lot, right? And so when you think about when we started in 2009, 2010, those were the first loans issued by the Loan Programs Office. And so a lot of the processes and procedures weren't in place. A lot of the risk management wasn't truly figured out between OMB and Treasury and DOE. And so today, I'd say a lot of that stuff has been worked out. So we're now in a place where we can do merchant risk. We can, use third-party merchant curves. We can underwrite loans just like a commercial bank would. I think one of the things that I think really confuses people is that, we're not a source of subsidy capital, right? We're really a source of liquidity for projects that, frankly, are not being prioritized by commercial banks or commercial lenders today. And so we're not really supposed to be cheaper capital, although we do tend to be slightly cheaper than commercial debt rates. We're really supposed to be folks who lean in for areas where it actually does deserve someone leaning in, right? The revenues from ERCOT are, quite calculable on a, sort of annualized basis. The revenues from low carbon fuel standard credit programs in California are quite calculable on an annual basis, even though they're merchant. So we are actively leaning into merchant deals right now.
Thanks, Jigar. It seems like that is a change in tenor, but I mean, again, the brass tacks of the practical reality of this is if I bring somebody in to see you, the question comes up, how do they demonstrate reasonable prospect of repayment for a project like this? It's not a traditional project with, secure offtake arrangements, be it a PPA or it's a regulated asset. So how do they demonstrate reasonable prospect of repayment?
That's a great point, Michael. Well, first of all, I think we have to start by saying the reasonable prospect of repayment is not some sort of judicial standard that is, adjudicated by the Supreme Court. It's adjudicated by the Secretary of Energy and the Credit Review Board that we have. So I think, the question really becomes, there are many sectors where the projects are 100% equity financed, right? So if you look at battery storage projects today in Texas, I mean, those are 100% equity financed projects. There's no commercial debt on them at all. Same with a lot of the biofuels projects out there. You've got some solid waste bonds that people have issued, which are horribly expensive once you count all the fees associated with putting those out. I mean, most of those are between 6 to 11% interest. So when you think about what we can do, we may not be able to get to 80%, advance rates on these and meet the reasonable prospect of repayment test, right? We have to find a third-party supplier of a merchant curve, right? So we have to go to Guidehouse or some other players, and they might have a horribly conservative curve, right? So it could be that we end up only being able to provide 25% advance rate on debt, right? At, a pretty reasonable cost of capital. But what we believe is that's a bridge to bankability, that by providing that debt, that we now are starting the whole conversation with commercial debt providers around, what is the right number? What are the right curves? What are the variables that people should be looking at, et cetera? And then that leads 4 years later for commercial banks to get comfortable with the same asset classes.
And under the current solicitations, a borrower applicant has to, at least as under Title XVII, get a preliminary credit assessment, which is really, as a practical matter, meant getting a credit rating. Is that a requirement that's going to continue?
Yeah, no, I mean, it stays for now. We do have the right to redo the solicitations and the rulemaking that underlies the program. That's as you know, probably 12-month or so process to get through. But after the Energy Act of 2020 changes, where we're dropping all of the initial fees and all the ongoing costs for the loan, and so those are all now deferred to the first funding event. All of those changes require a rulemaking anyway to be able to make those changes. And so we can absolutely revisit the credit requirement because it certainly doesn't exist for some of the USDA loans and other loans throughout the government.
Jigar, are there other practical considerations you would highlight for companies who are evaluating whether it makes sense for them to work on a project to come apply for a Title XVII loan?
Well, I think it's important to note that, we're the federal government of the United States, right? So this process is never going to be easy, right? That's not the goal, right? Like my personal motto for years has been, it's simple, not easy. And so I actually think we know what we're doing. We know exactly which sectors we can help. We have a huge number of applicants coming in now. I think we're averaging 2 or 3 a week. So we're actually back open for business. And there's a whole bunch of folks who now recognize that we're probably one of the only games in town for commercial debt. But I think that, you still got to fill out a whole bunch of forms, and you still got to fill out a bunch of paperwork, and you've got to give us a bunch of information and all of that. And I think we've gotten the adjudication, and diligence times down to roughly a commercial banking schedule. So we're at the 5 or 6 month level. So from that perspective, I think we're quite commercial. And so I think that's why there's a whole bunch of people looking at us again and aggressively coming in to use the program.
So I want on that 5 to 6 month timeline, is that from when somebody comes in and files what we call the Part 1 application, that first step application, or is that?
No, it's when they actually give us their diligence materials. So
this is once you've done through the Part 1 and the Part 2 process, and you've invited them to due diligence and to negotiation.
No, due diligence, I'm counting it from when they submit their information. So there are some folks who just skip Part 1 and just submit full due diligence documents, right? So it's really up to the borrower as to whether they are ready to go and are ready to really get money, or whether they're, what the point of Part 1 is to say that your technology saves greenhouse gas emissions and it technically qualifies under the different titles of the Loan Programs Office, right? So there are many people who aren't sure, and that's why they go through part one. But then part two is what a normal commercial loan app looks like, right? Where you put up a data room, you put all your information in it, et cetera, right? And so it's really the 5 to 6 months is the diligence process.
So that's really, again, sort of thinking about the way the solicitations talk about it. It would be after the part two, after DOE.
No, the solicitations don't really.
Well, they do
The
speak to a part
solicitation
one
is
and
a
a part
paperwork
two.
exercise.
Right.
It's not the way we operate the office.
Okay, but it is, if people want to apply, and technically you are, I know you say, you're the federal government, in some sense you have to live by the solicitation, right? So people come.
No, not really. The solicitation was a compromise made in 2009 by a lawyer who was super antsy about, us having to do solicitations. There's nothing in the statute that says that we had to do solicitations. So like current borrowers, there are some folks who are pretty confident that they're ready to go. They're giving us their full data set up front because they have it. And we're starting diligence on day one. So we don't have to do the part two process and then diligence. What we do is for people who are nervous and want to ramp up their investment into the Loan Programs Office process, then some folks inch their way through. They do part one, and then they do a little bit of part two, and then they see what the credit subsidy is going to be calculated at, and then they say, okay, fine, we'll now go into due diligence. For others who understand that, the liquidity function that we provide is hugely valuable, they just start with the full due diligence submission.
And if somebody wants to go to that sort of the full-blown submission, do all the usual verifications that are included in the solicitation apply? So there are documents you have to give, right? There are boxes you have to check. Are those same boxes?
Yeah. We have to check boxes. That's why they, hire firms like yours. And so I think that has to be done. But for companies who are, borrowing $800 million from our office, they're generally capable of doing all that work pretty handily.
And in terms of that timeline for when you guys start due diligence, is that envisioning that you will have already gone out and hired the experts? Because you typically have to go out and hire third-party experts.
Yeah, that's part of the process.
And an outside law firm, right? You need to get your own counsel.
Well, we already have folks on retainer, so we don't have to go out and do a process to hire somebody. In general, I'd say that.
Well, I'm going through now where you guys actually had to go through a process, and it's actually delayed us by several months.
Well, that's why I'm saying to you that your scar tissue is no longer relevant to the modern Loan Programs Office.
That's recent.
But I appreciate
that's scar tissue this year, Jigar. That's not scar tissue in past years. That's this year, scar tissue.
Well, no, I think that, we have folks on retainer. In general, I'd say that we have a 4 to 6 week process where we get everything lined up, right? And we do some of the checks politically, et cetera, to make sure that, there aren't any showstoppers from the president and secretary's agenda as well around what we want to be supporting within the Loan Programs Office. And during that time, we're also lining up all the consultants and all the other people that we already have on retainer. So we already have most of these folks in contracts, and we just have to select somebody. In general, we haven't seen that slow down the process. And so I don't think that's been the issue. The issue has been more around getting people who are qualified to do the merchant curves. And so in some of the technologies that we're looking at, it's not power. And so it's some sort of chemical that they're making, or something else. And in those cases, finding somebody who's qualified to do the merchant curves or to give us a clear picture around the commodity has been hugely challenging. And the applicant can certainly lead us in the right direction and help us find the smartest people. But in, one of the recent applications, it took like 2.5 months to find those people. And then, then we hired them, and then they need 2.5 months to submit their report. So.
Right. So, and actually, because this is a good question in terms of because I think it's in terms of potential clients, you have sort of a stable of people already on board as third-party experts and consultants. Are there areas that you feel that you have strength, and if people were to come to you, you'd be ready to run? And for example, let's take energy storage. Do you have people sort of looking at merchant energy storage, can understand and come up with curves?
We do, and so I would say that our suite of consultants in the power sector is quite robust. clearly, because many of the folks that we used back in 2010, 2011 have now added energy storage practices and, provide that service. And so I'd say the power sector is pretty robust. In the fossil sector, we've got a lot of internal resources around carbon capture and storage and other things. So frankly, I would say, some of the smartest people in the world are actually folks who work at Nettle or other, DOE labs. I think in some of the transportation sectors, the consulting services are hit or miss, frankly. There's, some consultants who are boosters, I would say, and some consultants who are actually, really dispassionate providers of information. And so sorting through that has been, a bit of a challenge, but, I think we're rising to the occasion. I think in some of the other areas like critical minerals, it depends on the critical minerals. So some of the critical minerals are pretty well studied, like lithium. Some of the critical minerals like copper or nickel or cobalt are far less studied from the perspective of the U.S. pricing and, how local pricing is going to be viewed, et cetera. And so we've had to, push people to, add practices in that area to help us. So look, it's a crapshoot. We have a lot of sectors that qualify for the Loan Programs Office, from pumped hydro to transmission to all of these areas. And, we stand ready to continue to serve all of those customers, but we expect the borrowers to have some, good advice for us around, hey, here are some of the smartest people in our space. You guys should look here for good consultants as opposed to just going to your universe broadly.
Understood. I think my question was more just focused on timing, because I think it is there as you are seeing on your side, there is a lot of interest. We're hearing it on our side as well. There's just a lot of interest, and I think one of the biggest, beyond the how do we satisfy the reasonable prospect of repayment, the biggest questions we get are around cost and timing.
Yeah, so I would say that